The Sahm Recession Indicator signals the start of a recession when the 3-month moving average of the national unemployment rate, also known as U3, rises by half a percentage point or more relative to the minimum of the 3-month averages from the previous 12 months. But what exactly is the Sahm Rule? The Sahm Rule is a recession indicator created and named after Claudia Sahm, a macroeconomist who worked at the Federal Reserve and the White House Council of Economic Advisors. According to the Sahm Rule, the early stages of a recession are signaled when the 3-month moving average of the U.S. unemployment rate is half a percentage point or more above the lowest 3-month moving average unemployment rate over the previous 12 months. The Sahm Rule has been widely recognized for its accuracy, simplicity, and ability to quickly reflect the onset of a recession. The unemployment rate represents the percentage of the overall labor force that is unemployed. This rate tends to rise when the economy is struggling and workers are having difficulty finding jobs, and fall when the economy is strong and workers can more easily find jobs. The Bureau of Labor Statistics, or BLS, typically releases the unemployment rate for the previous month on the first Friday of every month. The unemployment rate is one of the main economic indicators used to measure the health of the economy, and the Sahm Rule inputs the rate into a simple formula to determine whether the U.S. is headed into a recession. The rule compares the value of the current 3-month moving average unemployment rate to the value of the lowest 3-month moving average unemployment rate over the last 12 months. If the former is half a percentage point or more above the latter, the Sahm Rule indicates that the U.S. is in the early stages of a recession. The Sahm Rule uses the 3-month moving average unemployment rate, rather than the current unemployment rate, to prevent overreacting to a single month of data. The Federal Reserve Economic Data, or FRED database, includes current and real-time Sahm Rule recession indicators. Unlike the current Sahm Rule recession indicator, the real-time Sahm Rule recession indicator uses real-time data. It is calculated using just the unemployment rate and recent history of unemployment rates that were available in a given month. As Sahm has pointed out in her newsletter, the rule is an empirical regularity, not a proposition. She emphasized that this means that the rule can also be broken. For example, Sahm wrote in an April 2022 newsletter, "Imagine a scenario in which the unemployment rate increased, hovered around 3.5%, up from a low of 3%, meeting the criteria for signaling the early stages of a recession based on the Sahm Rule. However, if around that same time, GDP growth held around 2.5%, down from a high of 5.5%, and inflation gradually slid down to 2%, such a combination of circumstances probably wouldn't constitute a recession," she explained. The Sahm Rule is an indicator that looks at signals related to the onset of a recession. According to the rule, the early stages of recession are signaled when the 3-month average unemployment rate moves above the lowest 3-month moving average unemployment rate over the last 12 months by half a percentage point or more. The rule has become widely recognized as a recession indicator due to its accuracy and simplicity. The Sahm Rule was first introduced by macroeconomist Claudia Sahm in 2019 as part of a policy proposal.